P&L and VOE, I think I love these products most because it have better interest rates. We can do owner-occupied and non-owner-occupied transactions. For no docs, DSCR, we have to go with a non-owner-occupied property. So this one, we can do all type of property. But of course, when it's better in terms of rates, it's gonna be a little bit harder in terms of condition. Do you agree with me on that? Okay, so no docs, we don't ask for anything except we want to see the down payment. But when you see P&L and VOE, meaning we will ask something from the borrower. All right, but of course we still don't need tax return, W-2, pay stuff. That's a good thing. All right, so let's talk about P&L. P&Ls for whom? There are two different types. We talk about P&L and VOE. So remember, VOE is for W-2 earner, P&L for business owner. So the two different program, but it go under one big program. Okay. So for P&L, the first requirement is the business owner has to provide 2 years of business license to prove that he or she's own and run the business over 2 years. So beside the 2 years of business license and then the P&L, we need a letter from the CPA. The investor wants the CPA to be the person who signed the P&L, and the CPA license has to be on the P&L, and his signature has to be on there. Hai chị Vân Anh. So, and in the letter, the CPA had to also say something like, he confirmed this business owner owned this business for a certain number of years, and this business owner owned the business 100% or 50%. Of course, it have to be over 25%. And he also, if our borrower used the money from the business account, then the CPA also have to state that it's okay for the borrower to use the money from the account. It won't affect the business. All right, so the lender now is really rely on whatever the CPA stated in the letter and in the P&L. Okay. Of course, after all the conditions are met, before lender drawing the docs, they will call the CPA to do verbal verification. Okay. And for this program, we offer 30-year fixed and 7-6 ARM. So only two programs. There are no 15 years. There are no 5-6. All right. And this program, we can do owner-occupied property, second home, and non-owner-occupied. But for non-owner occupancy, when we do a loan for people who buy home for investment, they have to keep the loan for 2 years. If they pay off the loan within 2 years, if they sell the loan within 2 years or sell the home within 2 years, they have to pay prepayment penalty. Okay? So the last item is non-arm length transaction. Non-arm length transaction. Anyone remember what it means? It means the seller and the buyers have a relationship. For example, the son buy a house from the dad is the seller, and the son is the buyer. Or a sister sell a home to a brother, or friends sell to a friends. It's still relationship. Any relationship transaction called non-arm length transaction. And for this particular program, it's only allowed for owner-occupied. It doesn't allow for non-owner-occupied. Okay? That's it. Any question about non-arm lengths? If not, we can go on. All right. We was talking about P&L. Now we talk about VOE. So P&L is for business owner. VOE is for W-2 income people. Okay? We don't ask for their W-2 at all. We don't ask for their pay stuff. but the lender asks for a written verification of employment. And what is in that verification of employment form? It shows 2 years of income plus year to date of income. So in that form, the HR person will have to fill out. If somebody apply a mortgage now, 2022, that form will need to provide 2021, the whole entire years, and break down income of 2021 and 2020, right? 2020 and 2021. So 2 year, the previous 2 year, 2020 and 2021, breakdown income, and year to date of 2022 breakdown income. So that means in that form, we will see the base salary, overtime, or bonus or commission. Anything has to show in that form. Because if there is overtime, we can use the overtime. If it over 2 years, if the borrower earned the overtime over 2 years, we can use the overtime income. And it have to come from HR. How does lender know it's from HR? Because they will verify if the phone number there is the phone number of the company. They can search it up online, right? And before they draw doc, they will call that number and talk to the HR personnel to find out if all the things on the paper are true. So there is a verification of employment. The first thing is when we submit the loan, we have to submit a written verification of employment. But before they draw the loan docs, they do a verbal verification of employment. They want to make sure that comes from the company. You might ask, wait a minute, if I make enough income, why do I need to go with this program? Why don't I just give them my pay stub W-2? Correct. But what if in your tax return, you found so many lost, right? It might affect your qualification. You deduct so many things. We don't know. But a lot of time, people do this because the W-2 pay stub and tax return don't support the loan amount that they want to borrow. So that's why they have to go with the VOE program. Okay. So in the VOE form, they ask for HR desk phone number, not cell phone. During the time of the pandemic, it's really hard to get this done because most of the people, they work from home. So it was a lot harder than now. Now people going back to work. Okay. Okay, this program also offer 30-year fixed and 7/6 loan program products, and it also accept owner occupied second home and non-owner occupied transaction. Again, non-owner occupied, we need to tell our client it's a 2-year prepayment penalty. Also, non-arm's length transaction is allowed for owner occupied. So it's very similar to the P&L. The only difference is the borrower earning income. One is business owner, one is W-2 income. They are exactly the same thing, but different type of borrower. Okay, so that's why they are in the same products. Okay, now we are learning how to read the matrix. The matrix, we don't need to remember this because it's so many numbers. We just need to know how to read it. And we look from the top to the bottom, right? And when we read from my side, from right to left, or for your side, from left to right, right? So you read across the table. Okay, so on the top, very top one, it's purchase rates, purchase and rate term refinance. What does it mean? That means the top part is for purchase loan, rate and term refinance, right? So if we want cash out refinance, we go to the bottom. We don't read everything. this is not how we read everything. We just learn how to read it, but when we really read something, we go back to our own scenario. For example, I have a loan. It's 30% down, 700 credit score purchase. I will go here looking for 70% down and 700 FICO score. It's a purchase. So I know if it's a purchase, I go to the top part. I look for 30% down means 70% loan to value. And I know my loan amount is less than 1.5 million. So I look for what I look for. I don't just read every single thing, but when we read, we learn how to read, we're gonna read. Okay, the second row is it's for primary resident, second home, and investment property. So we know if our transaction is a primary resident or second home or investment, is still in that first table, part of the table. And we also see right underneath we have property type. So we need to know when you come to me, you say, Min, can you help me with this scenario? I have a client who wants this and this and that. I would expect you to tell me the entire scenario so that I can help you. And what is that inside? What is that scenario? Scenario including property type, loan amount. What is the down payment? Because the down payment would tell me the LTV, right? And what is the FICO score? So when you come to me, you ask me anything like rates or if we can do the loan, I will ask you back. Can you tell me the whole entire scenario? And if you can tell me, okay, Min, my client want to buy a 1-unit single family home as a primary resident with the loan amount $1 million, 30% down payment, and I know the FICO score is 700, then I can look, okay, so single family home, $1 million loan, that matching, and then 70%, 30% down means 70% LTV, and we only need 640 FICO score. But in this case, your client has 700, so he's good to go, right? So that's how we look into the table. We need to know everything. And if somebody come and say, my client wants to refinance cash out with a $3 million loan amount, do you have the program? I will go down here, cash out refinance, $3 million. Okay, I have the loan amount here for you, but what is the other requirement? Okay, is it a second home? Is it a primary or is it investment? It is a second home. Okay, second home, fine. $3 million loan amount. But the LTV had to be 65% if the FICO score is 700. Right, Alex? Got it? Mm-hmm. How about if the LTV is 55%, what is the required credit score?
660.
Thank you. So in this case, for example, our client have 700 FICO score. So what is the thing that I want to concern? I concern about the LTV. So for a client who want to borrow for 300 million, what is the home value have to be? If the home value is 5 million, is that good? Is that gonna work? Let me see. 65% of 5 million. Let me see.
A down payment, you mean?
No, I mean I want to see if the LTV. Okay, if you come to me and say, Min, the house value is 5 million. And I say, okay, 65% of 5 million is over to 3,025,000, right?
You mean the
if I said if the home value is 5 million, right, and 65% of 5 million is 3,250,000. So I say, you know what? We can do it because the home value is 5 million. But what if the appraisal come out 4 million only? What can we do? What if, okay, just think, if the appraisal come out 4 million, what is the maximum loan amount? In this case, 65% of 700.
Still the maximum amount.
Maximum amount for $4 million home value. What is the 65% LTV? 260?
2.6.
2.6?
Yeah.
2.6 million. So if the appraisal value came out 4 million, then the loan amount had to be lower. It had to be only 2.6 million. So it's not 3 million. So we look into this. Okay, what if somebody else come along, another client also want the same thing, but then his credit score is only 660? Now, assuming his home is 5 million, but because his credit score only 660, what happened? What is his maximum loan amount? At 660, maximum loan amount is 55 LTV. 55 LTV of 5 million, how much?
2.75 million.
27?
2.7 and a half.
Okay, 2.75 million. So for this case scenario, would somebody with lower credit score, because of lower credit score, he and she can only borrow up to 55% loan to value. Even the home value is really high. In this case, we don't have a problem with the loan, the home value, but in this case we have problem with
Down payment.
the credit score.
Oh, credit score.
The credit score, because of the low credit score, the max LTV go lower. So for this case, the maximum loan amount is 275 million instead of 3. So when we look into the table helping us to, it's kind of guide us to see what we can do for our client. It's really helpful because as a realtor, you know exactly what the home value is. And most of the time, our client know their credit score. And of course, this is a middle credit score, not the highest or not the lowest, right? We ask for them, do you know your middle credit score? If they don't know, that's fine. We can run the credits, right? And when we run the credits, we know their home value. We can tell them exactly how much they can borrow. Hello, everyone. Have you ever felt as if you pay too much for your mortgage points and costs after you sign your final loan docs? Have you ever wished that you could understand all of the numbers before you sign the loan docs so you can make your own decision? If you do, you are not alone. Therefore, we created a course called the Mortgage Points and Cost Masterclass. In the Mortgage Points and Cost Masterclass, you will learn how to identify the difference between origination points and discount points. You will be able to read and understand very important documents such as loan estimates, closing disclosure, settlement statement. All those documents are way too important to miss or not understanding. Also, when you learn this course, you will be able to answer 2 very important questions to yourself. The first question is, if I pay discount points to get lower interest rate, will that really benefit me? The second question, should I take the no points, no cost options? If you want to learn all of the above, then the Mortgage Points and Cost Masterclass is for you. If you register this class today, you will get the bonus class called Understanding the Promissory Note. If you want to register, please click on the link below. See you soon.